Stocks crash once the midterm elections are over. You have probably heard that line a lot lately. But open the history books and you find the exact opposite. Since 1950, the S&P 500, the benchmark index of the American market, has risen in the 12 months after every single one of the 19 midterm elections, without one exception. And the gains were not small, an average of 12 to 16%, close to double a normal year. 19 coin flips and 19 heads. So why is everyone still bracing for a crash? Because two scenes are burned into people's memories. The first is 2018, when the Republicans lost the midterms and the market collapsed at Christmas just 2 months later. The second is 2006, when the Democrats swept Congress and the global financial crisis erupted 2 years after that. Look at those two scenes alone, and the formula sounds plausible. Check the president, and the market falls apart. But dig into who actually caused those two crashes, and it turns out the election has been framed for a crime it did not commit. And this is not a story about some faraway country. A large share of the retirement money and the funds that people hold is tied directly to these American stocks. Should one election result make you tear up your whole portfolio, or should you ignore it completely? Let us hunt down the real culprit, one case at a time. Let us start with the year people fear most, 2018. In the midterm elections that November, Trump's Republicans handed the House of Representatives to the Democrats. It was a rout, a loss of 42 seats. A Republican president, with one chamber of Congress now in opposition hands. The textbook result of voters checking the White House. And exactly 2 months later, the market went through hell. In December 2018, the S&P 500 fell about 9% in a single month. It was the worst December since the Great Depression year of 1931. On Christmas Eve in particular, the index went into free fall, dropping close to 20% from its high and stopping right at the doorstep of a bear market. Investors were terrified. The opposition takes Congress, politics turns ugly, the country wobbles, and so stocks collapse. That story spread like wildfire. The logic that a governing party losing an election tangles up policy and frightens the market sounded quite convincing. And that winter, plenty of retail investors could not stand the fear, dumped their stocks, and walked away from the market. Stop the tape here, and the midterm crash theory looks like it is holding perfect evidence. But it is exactly at this point that a very important twist begins. The real culprit behind that crash was not the election, but America's central bank, the Federal Reserve. The Fed is where the country's interest rates are set, which in plain terms makes it the tap that controls the price of money for the whole world. Close that tap, meaning raise rates, and money dries up while risk assets like stocks lose their strength. When the Fed tightens because it is afraid of inflation, the side effect is that stock prices get pressed down. Over the course of 2018, the Fed raised that policy rate 4 separate times. And in December of that year, Fed Chair Jerome Powell sent a hawkish signal, hinting that he would keep tightening into the following year. That is the real reason the market broke in December. Not because the opposition took the House, but because of the fear that money was going to keep getting more expensive. The decisive proof comes right after. In January 2019, with a new year underway, Powell quietly changed his tune. He pivoted toward pausing the rate hikes, and even hinted at cutting them instead. The moment the tap was opened again, the market surged as if it had never been crying at all. In 2019, the year immediately after the 2018 midterms, the S&P 500 gained a full 31%. It was one of the strongest years of the past several decades. Anyone who panicked at Christmas and threw their stocks away had sold at the exact bottom. The election had done nothing wrong. What shook the market, from beginning to end, was the Federal Reserve. Now to the second frightening memory, 2006. This time the check on the president was far more severe. In the 2006 midterms, the Democrats took the House and the Senate at the same time. Under the Republican President George Bush, all of Congress flipped to the opposition, a complete and total check on power. And 2 years later, the world economy ran headlong into the catastrophe of the 2008 financial crisis. That year, the S&P 500 collapsed by 38%. It was the worst year since 1937. So it is hardly surprising that people are left with a picture of the Democrats sweeping Congress and the market eventually falling apart. But this picture is completely wrong too. The real root of the 2008 crisis was not politics, but a housing bubble. Back then, America was handing out money to buy homes, even to people with no ability to pay it back. Those bad loans were dressed up nicely and sold all over the world. And the moment house prices turned, the bombs went off in a chain reaction. That bubble had been quietly inflating for years, long before the Democrats ever won. In fact, if you only look at 2007, the year right after the 2006 election, the market climbed happily to a brand new all-time high. The crash arrived a full 2 years after the election, for entirely different reasons. Here too, the election is innocent. and the real culprit was somewhere else. So why do stocks actually rise after the midterms? Three forces stack up on top of each other. 1. The uncertainty lifts. The thing the market hates most in this world is not knowing. Walking down a staircase blindfolded makes every step terrifying. But take the blindfold off and your feet relax. Money that stayed cautious before the vote, unsure who would win or where policy would swing, comes back out to take risk once the result is fixed and the fog clears. 2. The presidential term cycle. Historically, the American stock market has done best in the third year of a president's four-year term. Since 1950, third-year returns have averaged around 16%, and the market rose roughly 9 times out of 10. Because the midterms fall at the end of year 2, the period right after them lands squarely on that golden third year. It is also when a president, with the next election coming, tries hardest to prop up the economy, so money tends to flow. 3. And this one is a little surprising. The market actually welcomes divided government, where the two parties split control of Congress. Divided government means the president's party and the party controlling Congress are different, which in plain terms means the two sides spend their time grabbing each other by the ankles. It looks frustrating at first glance, but from the market's point of view, it means neither side can casually pass a law that turns the world upside down. The rules of the game stop changing, and that makes the future easier to calculate. In fact, in the years when Congress was split like this, the American stock market delivered positive returns for 13 straight years. The deeper the political gridlock, the more comfortable your account gets. An awkward little truth. So what happened when it was not Congress, but the presidency itself that flipped from Republican to Democrat? The outcome was the opposite each time, and the reason why tells you the heart of this entire story. In 2008, power passed from the Republican Bush to the Democrat Obama. At that moment, the market was already being torn apart by the financial crisis. But precisely because Obama started at the bottom, the spring of 2009 became the low point from which the longest bull market in American history was born. In 2020, by contrast, when power passed from the Republican Trump to the Democrat Biden, the post-pandemic economy came roaring back and the index jumped 38% in his first year alone. In both cases, the Democrat won, but one of them was standing in the middle of a crisis and the other at the start of a recovery. The winner wore the same party colors, and yet the fate of the market was the exact opposite. So what does that tell us? What sets the direction of stock prices is not who walked into the White House, but where the economy happened to be standing at that moment. Take power at the bottom of a crisis, and there is nowhere left to go but up. Take it at the top of a bubble, and the way down is waiting. The president is only a surfer riding the wave, not the one who makes the wave. What makes the wave is the business cycle, the Federal Reserve, and how expensive stocks happen to be at that point. So the formula that says if this party wins the market does that was never valid in the first place, only an optical illusion. By now you might be thinking you should simply buy everything after a midterm election, but it is not that simple. The other side of the argument deserves an honest hearing. First, that glittering statistic itself is worth doubting. One major bank dug through 125 years and 31 midterm elections and found that the apparently higher returns after an election were statistically close to meaningless. The reason is that the sample is far too small and the variance far too large. Some years fell more than 30%, and some years rose by nearly 50%. Declaring that stocks go up after elections on the basis of a few dozen wildly scattered numbers is a bit like flipping a coin a handful of times and calling the outcome a law of nature. In fact, some analysis shows that when a governing party loses its complete grip on the presidency, the House, and the Senate all at once, the 6-month return after that election was noticeably weaker than in other cases. That is because policy disappears back into the fog. More important than any of this is where the market is standing right now. The Shiller index, the best-known yardstick for how expensive stocks are, sits near 40 today, matching the peak of the dot-com bubble in 2000 and making this the second most expensive market in history. A market already inflated to that degree can lurch violently even on a small shock. It is like a heavy body, a light push, and down it goes. So the thing to really watch is not the vote count, but where the Federal Reserve takes interest rates and how long this expensive valuation can hold. The election is noise, and the real signal is always somewhere else. So how will the 2026 midterms actually play out? Here is what the prediction markets are pricing right now. The odds of the Democrats taking back the House are above 70%, while the Republicans are likely to hold the Senate. Trump's approval rating sliding to around 30% is acting as a tailwind for the opposition. Elections held in the middle of a presidential term are usually rough on the governing party, and that formula appears to be working exactly as usual this time. If that picture becomes reality, the result is divided government, a Republican president and a Democratic House, with power split between them. And as we have seen, That gridlock is historically the combination the market has liked best. On top of that, the golden third year of the presidential term arrives at the same time. So on a big picture view, the odds that the midterm election itself pulls the trigger on a crash are low. If anything, the lifting of uncertainty makes it an easy excuse for a rebound. The real danger, though, is not political, but somewhere else entirely. It is the second most expensive valuation in history, the bubble piling into artificial intelligence, and the Federal Reserve's next move. If the market does break badly in late 2026 or in 2027, the trigger will almost certainly be pulled by the Fed or by the bubble. And yet when that crash comes, people will once again point the finger at the innocent midterm election, exactly the way they blamed the election for the Federal Reserve in 2018 and for the housing bubble in 2008. So please do not let one election result scare you into tearing up your entire portfolio. What we need to watch is not the ballot box, but the Federal Reserve and valuations. If you want to walk through these macro currents together every day, subscribe and come along.